Good afternoon and welcome to CW's webinar on the recently released Volume Forecast Report, second half of 2018 edition. Following extensive research, in-depth analysis and focused reporting on 57 markets around the world, the extended version of our twice-a-year release report is here, having already reached its subscribers last week. As a lead analyst of the study, it is my pleasure to present you with the results of my team's work for this report, which is already a staple for professionals involved in the supply chain of the cement industry, investors and consultants alike. We'll be giving you a small glimpse at the content of the report, more of a helicopter view of our findings, focusing on the bigger picture and on the global view, while in the report itself you can find the exhaustive detail about all the markets that we cover. I'll start off with a short intro to our company. As many of you know, we are a boutique advisory group based in the United States with a specific focus on providing market intelligence in the shape of research products or consulting projects to clients from varied industries. As you can see here on the left side of the page, we don't only cover the cement industry, but also other building materials, the steel and metals and mining industries, the chemicals industry. We also keep a close track on dry bulk cargo, port and infrastructure, as well as power, energy and solid fuels. Cement is, let's say, our core industry, and it is also the one with which we started our company. So it continues to make the bulk of our research. We are well known and respected in the industry, and we are a source of information and analysis to clients that constantly return to us to stay up to date and informed. Now, we have a couple of ways through which we keep our clients informed and provide them with access to the business intelligence that we analyze here at CW. To start with our advisory branch, we have been extremely lucky to work with clients around the world from various walks of life and from various industries, be it cement manufacturers, cement equipment manufacturers, lime and graphite manufacturers, as well as investment banks, international funds, and many others. The projects span from commercial and technical due diligences to strategy formulations and pretty much everything in between. We're proud to say that we have successfully helped large and small corporations alike realign their businesses and set them up on the path of growing profits and operational excellence. Moving on to our research branch, to which the report at hand actually belongs to, our focus here is to provide analyzed data in the shape of actionable information, which is meant to help business professionals like yourself make highly informed business decisions. Apart from cement volumes, through other reports that are part of this branch, we track cement prices, traded volumes of cementitious materials, global markets for other cementitious materials, the cement equipment market, but we also cover a larger span of industries that may or may not be related to the cement industry. Some of such projects, just to drop a few names, include our lime report, our quick lime and hydrated lime report, our dry mixes studies, our graphite studies, refractory studies, and many, many others. And lastly, and to pretty much wrap with our overview of our company, our media branch, which I pretty positive many of you are familiar with, and perhaps that's how you ended up here today on this webinar. Our media branch, the core of which is CEMWeek.com, is meant to keep subscribers up to date with the latest news from the industry. We don't cover only cement, we have dedicated platforms for industries, including the pet coke industry, the coal industry, the paper and pulp industry, the bulk movement, and also the other building materials apart from cement. Our colleagues from the media department also publish a monthly publication, a magazine, where you can find very interesting interviews with business stakeholders, as well as features on the most important marketing developments, and also insights from CW research analysis. Now, to dive straight into the report at hand today, the Global Cement Volume Forecast Report, the 2H 2018 edition, I'd just like to take a couple of moments to explain what you can find in the pages of this report, our methodology, and afterwards we'll dive into the highlights of the report itself. Now, we publish this report twice a year, and the current update, the one that we publish in September, October of each year, is the extended one. While in February, we publish a smaller update where we basically update our previous forecast and discuss the latest changes with a material impact on the market. Now, in this update, however, and also in each second half update, we profile in depth all of the 57 national cement markets covered by us and justify our individually analyzed 5-year forecast for each of them concerning production, consumption, capacity, utilization rates, and so on and so forth. And we do this by providing an understanding of the bigger and smaller threats and drivers with a short and medium-term impact on cement volumes. We also analyze, of course, other markets in order for us to offer you an aggregated regional and global view, and more on that in the following pages. Now, here you can actually see with at a larger level of detail what you can find in this report. Important to say is that we treat each country that we track individually, and that the forecast that we create is mostly determined through a very thorough qualitative-oriented analysis more than a quantitative one. Of course, we do consider quantitative reasoning as well in the form of statistics, but we make it a point to look under the hood of, let's say, each of the national cement industries and identify country and regional particular risks and drivers. As probably most of you today know, there is a great variety of drivers and hinders that impact the cement market, which is at the end of the day very susceptible to outsider influence from a geopolitical to a, let's say, economic level, but more on that in the coming pages. And to move on to the methodology and referring to the point I mentioned earlier, here you can see the detailing that goes into our forecast methodology and the amount of sources that we use and abuse to formulate opinions and forecasts for the market. We look at announced and current capacities. We identify companies' expectations. We assess how granted these expectations are in reality or not. We conduct a thorough analysis of market-specific supply-demand balances and proceed to form our own views on the market. Of course, being a 5-year forecast, it is not our intention to say that our forecast is bulletproof, far from it. This is why in the 1H version of this report, we also make it a point to review our previous forecast and to help our clients understand what has changed and how that impacts our forecasting. Now, buying this report involves purchasing 2 updates. It's, let's say, an yearly subscription. And the report is delivered to our clients in hardback copies. And the client also has the option to include in their order client Excel, where all of the data is included, and it's a very useful tool for our clients. Now, to move on to the meat and bones of this report, one of the main factors that lies at the foundation of the forecasting that we do is macroeconomic. Why? It has a trickle-down effect on construction activity and, of course, at its turn on cement demand, both at the global and country level. Now, at the global level, since I mentioned that today we're a bit more focused on, let's say, the macro view and the bird's eye view, let's put it like that, there are some themes that I would like to bring your attention to. Of course, in the pages of the report, each country that we profile has a very well organized and researched macroeconomic chapter together with an overview of the construction market, both looking at what's actually happening in the market at the moment and what is expected to happen in the short and medium term future. Now, to go back and look at the world from a bigger distance, though the world is, let's say, currently in a stable position from an economic growth perspective, there are definitely some risks that lurk around the corner, which could have say, potentially detrimental effects on the economy. We are looking at various themes, as you can see on the page, some that I would like to bring to your attention. Elections in Europe, where extremist, nationalist, and anti-EU parties are seeing an unpaired amount of popularity, and that's threatening to distort investor confidence and somehow unsettle the stability of the euro on the medium term. Still on the election page, we're looking at midterm elections in the US, highly anticipated, not only in the United States, but also, I'd say, around the world, for different reasons. Nonetheless, regardless of the outcome of the elections, we'd say there's some turbulence bound to happen on the stock market, which has fortunately been riding a stable growth wave. But we will probably see some shaky waves there, with a potential impact on the construction sector in the US, but also could be around the world. Another theme that I like to point out is the one regarding trade wars, a recurrent theme since our last update, which has already taken a toll on geopolitical stability, not so much yet at the let's say country level in the US, a bit in China though. Nevertheless, a large-scale effect has yet to be seen, likely to happen in the short-term future, we'd say. Now, how does that translate into figures? We're looking here at real GDP growth for the past year, the one estimated for the current year, and the one estimated for the next year. And it would seem that there is no real reason for concern. We're not seeing negative performance forecasted for this year or for the next one. Everybody is, let's say, on the positive side of the chart, but we do see a slowdown in growth in a few markets that are essential in driving global growth, namely China and advanced economies. Now, the advanced economies have already seen quite heated growth for advanced economies in the past year, as well as this year. So a cooling down is something that we have already anticipated and to some extent is welcomed by these economies. Now, China's performance, on the other hand, is more impacted by an assumed slower growth policy, and the government is keen on it and considers it essential for the maturity of the market. If we look, let's say, across the Pacific to the United States, where the economy is definitely booming at the moment, with productivity at historical highs and unemployment rates at historical lows, there is, let's say, scant evidence of material slowdown in the near future, given that factors that were seen as imminent risks have yet to destabilize the economy. And I'm speaking here specifically about the trade frictions with China, European countries, Canada, and Mexico. Nevertheless, there are underlying issues in the US's economy, and perhaps the biggest one with a big impact on construction activity and therefore on cement demand is the fact that the current debt ratio is high and growing higher. It has prevented Congress to pass policies that would lead to a more expansionary spending already. And I'm speaking specifically about expansionary spending meant to support infrastructure funding plans. Now, if we look a bit historically, and this is more of a, let's say, thought experiment, at the cyclicality of economies, there's a clearly identifiable pattern. At the moment, as you can see on this graph, there are no markets experiencing a recession, with the exception of, let's say, the extreme black swans, such as Venezuela. We see Brazil and Russia peeking their heads out of the water following an unstable period. Nevertheless, regardless of how positive this graph might look, growth is always followed by a cycle which usually leads to a recession. Now, experiencing slow growth at the moment are China, Turkey, and the UK, to name just a few large economies, with most indicators leading us to believe that Turkey is headed straight into a recession as a result of monetary instability and political disarray, while on the other hand, in China, this is an assumed slowdown, unlikely to head straight into a recession, as the government will probably be very effective in keeping things in check. Now, to look at how the favorable but risky economic outlook is currently and will impact cement demand and production, we'll move on to the next slides. Now, a simple look at this map will show you that there are reasons for optimism. This year, we're looking here at 2018, change in demand year on year compared to 2017. I'd also like to draw your attention to the fact that all the markets that are colored are the ones that we track in the report, whereas the ones that are in white color are not tracked in the report individually. They are nevertheless considered when assessing individual regions. Now, the colors red, pink, and the yellow shades show an estimated positive year-on-year cement demand growth for 2018, while the blue color indicates negative performance of cement demand. Speaking first at a global level, regardless of the map being fairly red-hued, we are looking at a slight decline for 2018 due to China's decreasing consumption of cement. Now, it's not a huge decline globally. We're speaking about a year-on-year decline of 0.2%, which is fairly minimal compared to the 1.5% decline of 2017. As such, we estimate that by the end of this year, demand will be 4,045 million tons, so 4.0 billion, while per capita consumption will be 544 kilos, which is actually a 1.2% year-on-year decline in per capita terms again. Now, to look at the root of it all and to look at China, the cooling of construction spending, particularly when looking at public projects, which of course make for the largest construction sector in China, is a consequence of authorities pledging to focus on debt management. And as a consequence, to give you a few examples, China has suspended subway projects in some cities and tightened regulations around public-private partnerships in the construction industry. Now, China's consumption of cement decreased by 3.1% last year, year on year. And speaking about this decline, the Chinese Cement Association confirmed that it was due to the lack of investments in infrastructure, lack of investments in the real estate sector, that we had to witness this decline. Also, this year, the government introduced regulations on further regulations on real estate, namely access to loans, that will contribute to a decline of, they say, 4 to 7% in the investment made in real estate. Now, for 2018, our estimations show a 2.8% decline for the Chinese cement demand. And of course, this is also in line with the other industries, the other Chinese industries' performance during the year as the country enters a mature stage that we saw in Western markets, let's say 20 or 30 years ago. So a slower demand is definitely a cyclical, definitely has a cyclical explanation. Now, at the global ex-China level, however, so if we don't include the negative performance that the Chinese sector is having right now, demand will likely improve by a healthy 3.3% growth in 2018. This is one of the highest margins seen in the couple last years, and it will reach 17.85 million tons. Now, capacity-wise, and of course, this has an impact. And to start with China, the giant of the industry, all cement capacities continue to remain prohibited in 2018 in China, and even on top of the existing legislation that was making setting up new capacity difficult, there's new regulation making it even more difficult. The most recent regulation that came to the producers' plate is that producers have to pay specific fees for captive power plants, making it increasingly more expensive to manufacture cement. Now, if in 2017 the Chinese cement capacity accounted for around 50%, 51% of the annual global capacity, its share is likely to decrease by about 2 percentage points this year alone. At the global ex-China level, so if you look at the bottom chart, cement capacity additions reached 105 million tons in 2017 alone, while for 2018 the estimated additions amount to 118, out of which Asia ex-China alone is adding 35% of those additions. Globally, the countries adding the largest chunks of capacities are India, Turkey, and Egypt. Worthwhile mentioning are also Algeria, which is gearing up to add an additional 10 million tons of capacity in 2017. Nigeria, we anticipate that its cement production capacity will actually expand at a CAGR of 10.5% over the coming 5-year period. India is, of course, the second largest cement producer in the world, currently accounts for about 40% of the Asia ex-China cement capacity, and has announced huge amounts of new capacity coming to the market this year alone, as manufacturers are racing to ride this growth wave India is experiencing. In the Middle East, Iraq is actually the market with the most capacity is being added. 4 million tons of new capacity are expected to be inaugurated by the end of the year, of course, in an effort to make the market independent from imports and prepared for the massive reconstruction efforts needed in the aftermath of the ISIS conflict, especially in the north of the country. Now, at the regional level, and to move straight to the cement demand forecast for the next 5 years, here you can have an understanding of regional divergences. On a regional level, cement demand will, of course, continue to register different performances across regions. And I will go through each or most of the regions here and try to explain the reasoning behind our forecasting. Now, if you look at North America, we're looking at kind of a moderate growth in 2018. Demand, we anticipate, will increase by 3% year on year for the entire region. Whereas in the United States, we think cement consumption is going to grow at a CAGR of 2.8 from 2018 to 2023, slightly higher than the regional average, and definitely a bit slower than we had previously anticipated, for the simple reason that many of the large infrastructure projects that were highly anticipated have yet to come to fruition. The cement market continues to be fairly rooted in movements happening in the residential market, a sector which is growing great in the United States, but is of course subject to political and economic foes. In Western Europe, we're expecting a 2.8% year-on-year increase for cement demand in 2018 to 129 million tons, whereas for the 2018-2023 period, we're looking at a CAGR of 2.2%, as certain markets with the power to drive the cement market are showing healthy cement demand developments. Speaking here specifically about Spain, France, Germany, and definitely to a lesser extent about Italy and the UK. Now, African markets are estimated to show sustained growth in 2018 as well, but not as high as we had expected in the previous update. In 2018, we believe that the year will end with the average regional consumption growing at 1.6%, and as for the 5-year period, we anticipate an average growth rate of 3.6%. Markets that are, let's say, negatively affecting the regional average and preventing the type of growth that we saw in previous years are Kenya, Egypt, and Tunisia. And Kenya specifically, there's let's say, a situation of sudden political uncertainty caused by the somewhat aggressive presidential elections, coupled, of course, with lower construction activity, project delays, overall bureaucratic chaos, which have affected cement demand. Now, in the Middle East, as an aggregated region, we expect to see a decline in 2018, namely 0.4% year-on-year to 168 million tons. Why is that? The markets that traditionally support the majority of cement demand in the region, namely Iran and Saudi Arabia, are both expected to see a decrease in demand in 2018, as you saw on the previous page. I would say we're being cautiously optimistic about Middle East, and chances are that 2018 will end with even a larger decrease in demand. Nevertheless, on the long run, the regional average is expected to recover, with cement demand expected to grow at 2.7 CAGR between 2018 and 2023, reaching 189 million tons. There are huge mega projects in the Middle East. UAE, Saudi Arabia are filled with these mega projects, and we truly believe that these ambitious projects will be unlocked once oil pricing climbs even higher. Of course, these markets are continuing to make efforts to diversify their economies, but revenue from the oil industry still supports the majority of state-mandated infrastructure projects, which make for the largest chunk of construction activity in the Middle East. Now, in Latin America, positive signs this year after several consecutive years of declining demand for cement. In 2018, we estimate that cement consumption for the entire region will grow at 1.4% to 171 million tons. And by 2023, we expect an average growth rate of 2.4%. Now, the regional outperformer in 2018, we believe to be Argentina, a previously troubled market, but where now domestic demand increased on account of an excellent construction sector. Speaking here about large infrastructure projects such as dams, highways, bridges, and tunnels. Brazil, the megamoth in terms of cement demand in the region, we believe that the cement market, along with its economic situation, will stabilize in the following years. However, regardless of how optimist we wanted to be, in 2018, due to political uncertainty caused by upcoming elections and slower economic recovery, we believe that cement will grow, but very slowly this year. There's a lot of, let's say, black swans hitting the Brazilian market. Most recently this year, the truck driver strike affected the performance of cement manufacturers in the country, which basically had no means of delivering to their clients. Now, that being said, I think the key takeaways at, let's say, a global level from this presentation and from this report are related to, of course, the economy, which we truly believe has a trickle-down effect straight into cement demand. Regardless of the positive indicators, the growing wave that it seems everybody is riding, one has to be cautious about the medium-term indicators that point to a recession. Insofar as the cement industry goes, the commodity prices recovery will have very positive effects in Asia, ex-China, Africa, and Latin America. So we do believe these markets will make steps to recover to growth levels that are at least near to what we saw in the past. And lastly, as you saw, 2018 will be one of the largest cement demand growth at ex-China level since the 2008 crisis. Definitely encouraging for manufacturers and cement equipment manufacturers alike, and hopefully this will continue to be the case. Now, let me thank you for joining. If you have any questions, I welcome you to email me or to visit our website and to drop your questions there. This webinar will be made available for downloading, both the PDF and the recording, in 24 hours. Thank you so much for joining and have a great rest of the day.